Good afternoon, everyone. Welcome to our Selecting an Option Strategies webcast. I'm Connie Hill. Whoa, we just heard the closing bell there. Happy that you have joined me here on this Thursday afternoon at the closing bell. This is a time where we compare and contrast different strategies and try to identify what might work in certain scenarios. Now, when pricing an option, we've got price, time, and volatility that are the three components, right, of option premium. How comfortable are you with identifying implied volatility and the impact of implied volatility? And if it's high and if it's low and the different numbers and where those can come from? By the end of our session today, I want you to be really comfortable with that. Okay. So that you feel like, oh, I see that number. I know what that means. I know how it kind of fits in with whatever strategy you're thinking about. All right. That's where we're going to go with that today. I'm happy that you've joined me. I hope you're following me on X. I'm Connie Hill, CS. We have the pleasure of having Cameron May in the chat here today. Cameron's fellow coach, longtime friend, big veteran of the markets. He's here to maybe help fill some questions I can't quite get to. I'll keep my eye on the chat, but I might not be able to catch everything. And so when you have those questions, go ahead, put those in. Now, those of you that are listening on the recording, because I know lots of you listen there, when you have a question, put your question in the comments section on YouTube, because I go back and review those so you can get your questions answered quickly as well. Well, got a pretty detailed agenda here today. Let's go through our disclosures and I'll lay out where we're going to go. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for education and informational purposes only. Don't consider it a recommendation of any sort. We are going to be using the Paper Money software application. It's what you download to your computer. It is the most robust version of Thinkorswim. And so you're going to see us using it in our classes. But it is an educational tool, and there are some differences between it and a live Thinkorswim account usage. Investing involves risk, including the loss of principal. Past performance of any security or strategy does not guarantee future results or success. One thing that's different in a paper money account than a live account is the paper money account will not assign early. And a lot of the strategies that we work with here, we're short an option. And so we just want to recognize, even if it's in the money and paper money doesn't assign, it still could happen in your live account. So we try to make sense of that here. All right. Agenda, typically we just kind of take a quick look at the market, see what has been happening. I think you guys are probably on top of it quite well, so we don't spend a lot of time there. But I do want to talk a little bit about what strategies we might be looking at, and I want to follow up. We've got some great things to follow up on from our couple of trades, 3 trades we had on last week. And then, of course, we're going to put on some new example trades. And one of those I got in before our class started, because it has to do with an earnings announcement. Ooh, who might be announcing this afternoon? Well, it could be Nike, so we may have an opportunity to take a look at that. All right, let's head on over to Thinkorswim. And I'm glad that you like the bell when it rings. It hopefully reminds you instead of the beginning of a class. Perfect, I like that. Yeah, absolutely. You like it when the bell rings. The pain subsides. Oh man, I hope you're not in pain. But I do recognize, I remember in my early trading days when the closing bell would come, I was like, oh good, the trading day is over. I can relax a little bit now. I do remember those days. All right. Here's our SPX. I've got a 1-year chart up here. I also have the implied volatility graph. It's just a study you put on your charts. I made mine a little bit fatter because I like to really see it instead of the little skinny lines. But let's look at price action here. We've talked a lot about the SPX. Maybe it's forming a reversal pattern. Maybe it's not, right? We had a shoulder, a head, a shoulder. Again, I've got to figure out why my tools don't want to work for me. In any case, yesterday, the market kind of went below this little peak over here, looking like it might have some weakness. Today, it looked like it rebounded off of that. And for the most part, the market was up, although there was definitely pulling back off its highs. Okay. The NASDAQ has not been as strong as the SPX. And but the NASDAQ has a somewhat similar pattern in that possibly head and shoulders forming, right? This would be the first shoulder. Up here at the top where the high is would be the head. Right here would be the second shoulder. Now, generally, December is a pretty bullish month historically in the market, but doesn't mean it has to be. Doesn't mean it's guaranteed. And we'll talk, we won't talk this week, but maybe next week we'll talk a little bit about the Santa Claus rally. It will not start officially, according to the Trader's Almanac, until December 26th. Okay. But big pullback day yesterday. Nice little bounce back today. Looks like the NASDAQ ended up closing a 1.5% up. So maybe it's finding a little bit of stability here. And we can see the volatility dropped on this as well as the SPX today in terms of implied volatility. All right. Let's take a look at before we. Well, let's do this. Let's go back to. Let's come back here for just a moment and look at the different strategies that we tend to focus on in this class. When the market's more bullish, man, we really focus on these strategies here over on the left and do a lot of them. Market gets in a more sideways situation, maybe some uncertainty, or maybe if you're trying to play both sides of the market, a bullish and a bearish move, we might consider that a neutral strategy like a straddle. And so there are some neutral strategies that we might use. During the course of the year, we've had a pretty decent trending market. And so we've utilized this list over here quite a bit. We haven't had many opportunities to go bearish. There are bearish stocks out there, and there's stocks that are rotating out of favor right now, right? That you probably saw them two months ago, and they were up on your bullish list, and now the trend is such that you might consider them for a bearish trade, okay? However, probably isn't going to be the majority of what you focus on. You want to typically be in sync with what the overall market is doing and giving us so that you're not swimming upstream, right? If you put on a bunch of bearish trades when the market's bullish, that can be difficult to deal with, okay? So, all right, let's talk about some trade review. I think it's important in this class that we review trades, see what happened, see what decisions were made and why they were made. So let's hop back here to our paper money. And first couple of trades we're not going to look at for very long because there's not a ton to do. This is a 1-year chart. I'm going to maybe take us to a 3-month chart. So we're just kind of looking at the recent activity. On ConocoPhillips, we got in here when it was breaking out of this sideways consolidation. Sure enough, it ran up about the height of this pattern here, the height of that rectangle. Interesting, it went up there pretty quick, pulled back, maybe looked like it was bouncing here yesterday, but then pulled back here today. So we've been in the trade for 2 weeks. It's a short put vertical. So really, we just need the stock to stay above 90. Most of the time, it's been doing that. In fact, it hasn't even dropped below 90 since we've been in the trade. So if the stock looks like we lost the connection there for just a moment. Fortunately, we weren't gone that long. Hopefully you're hearing me now. I'll wait for some feedback in the chat to let me know that you guys are indeed back. So feel free to let me know, you guys or Cameron, okay? Basically, we were just looking at ConocoPhillips. And on ConocoPhillips, this is where we got in the trade. We've got a short put vertical going on here, 87.50.90. It expires in January, so it has quite a bit of time. really hasn't done a lot. We've just seen a lot of time decay. More than anything, earlier yesterday, we were still back on yesterday, we were up on the trade, but the stock did pull back. It kind of dropped down here in the morning, gapped down a little bit, and then continued to drop, but it's still in an area. If this stock just went sideways the rest of the time, would still be in good shape and would still be collecting that time decay. All right. So this is a trade we're just going to let work. We're down on it a little bit. We brought in a 64-cent credit. If we wanted to close it out, we'd have to pay 70 cents for it. So we're down a little bit, 48 bucks. Not a big deal. It's working for us. We're going to continue to let it work. All right. Next one up is going to be Barrick Mining. Barrick Mining was a trade we put on last week. We actually did 2 trades so that we could compare and contrast them, how they were performing based on whatever the stock was doing. So let's go look at the stock first, and then we'll come back and look at these numbers. On Barrick, we had a stock that's kind of been upward trending, and we had some spikes. We saw spikes in silver, gold, copper, mining type stocks. Okay. We saw a nice little run up here. We looked at it on this day. That was on it last Thursday. And then we entered the trade in on Friday, where I have the oval. We would have entered into the trade probably up here, closer to the opening price, even though it fell during the day. So what has it done for us? Well, it's kind of gone sideways, hasn't it? It hasn't really done a whole lot yet. So I want to show you my lines here. And let me fix this one. Let me edit my properties here. I want it to show up. There we go. Here are our 2 trades. So we have a pretty conservative trade, a short put vertical. It's a 40-42. All we need it to do is stay above 42. Has it stayed above 42? Yeah, it has. Okay. It could sit there, it could bob along, not do a whole lot of anything. And if it continued that way, stayed above that 42, we could end up in a profitable trade. It might take a little time to get it all or get a chunk of it, just because it hasn't been moving so much. When it moves, man, that really helps the trade out a lot. Our other trade was more aggressive. We did a long call vertical. We did a 43.45 long call vertical. It was one that we said, yeah, we're expecting quite a decent move out of it. It really hasn't given us much of that yet. It needs to move. It looks like its high is 44.38. Did that today, but we really need it to move. We need it to get above 45 before options expiration, so it gets in a position that we can be positive in the trade. So this trade, more conservative, doesn't have to do a whole lot. This trade, stock needs to work a little bit. What do you think those numbers look like on those trades? If any of you are paper trading these along in your paper money account so that you're getting more comfortable with the strategies, as you've had questions, go ahead, let me know. All right. But that's where you're going to learn a lot better, is by doing it yourself. Cameron, you can watch Cameron trade all day. You can watch me trade all day, or whoever, but it's really doing it yourself that really teaches you some lessons. Okay. Let's come over here to Barrick. Okay. So here's our short put vertical, our one that's in good shape. We collected 72 cents for 11 contracts. It's down to 57. Okay, so it's going the right direction. Time decay is working for us. And we're up a whole, I guess, 159 on the trade. Not a bad start. All right. How about our stock or our trade that we need it to move? The 43.45 long call vertical, where we need it. We're short on the 18 contracts here of the 45. We need it to move. Well, we paid $2.60 for it. We're up a whole 8 cents. We're up to $2.68, but on 18 contracts, that adds up a little bit. So we're up $1.98 in the trade so far. So we're just going to let them work. They don't expire for 29 more days. So we have time on our side to continue to allow it to work. And many times when we're doing these trades that are Verticals are trades of patience, especially those short verticals. However, one thing I do want to point out on you, we could have, if we wanted to, just done a long call option here. But I did want to compare the two verticals. If we had just been long on our 43 contract, we'd only be up 8 cents on it. Actually, I pointed to the wrong line, didn't I? I said 260, and it really actually was the higher line. It cost us 83 cents to get into, and now it's worth 94 cents. I was pointing to the wrong line. I apologize. Okay, that's just the this is the difference between the two, which is really what we're focusing on. So we're up a whole 2.5%. So we're going to let them work. All right, nothing to actually do there, but say, all right, you're in there. We've got our exit orders in there. If we get a chunk of the max profit that we were interested in, if we get it, we've got orders to exit us out of the trade. All right. Let's take a look at Nike. Now, if any of you are watching for Nike earnings tonight, great. Feel free to update us in the chat, okay? I'm actually not seeing any new chats come in, so I hope that I haven't seen any new chats come in for the last 10 minutes. So I'm hoping that I'll be able to see your comments here. I currently am not seeing them. I'm gonna, I do see Scott. Last comment I see here is from Scott saying aloha to Will. If that is the last comment, good. I am up to date, but it just surprised me there weren't more comments here. Okay. Oh, Scott's letting us know. Okay, now some of your comments are coming in now. All right, excellent. Now I'm seeing your comments. Perfect. Tommy Surya says, "Deer in the headlights, where do I start?" This is a more advanced class, so I'm happy you're here. Pick up what you can. You might feel a little overwhelmed with what we're talking about here until you get comfortable with some strategies. Cameron, who's in our chat, teaches a Getting Started with Options webcast. Cameron teaches that class Tuesdays at noon Eastern time. It's called Getting Started with Options. And he'll go through, he does a great series on it. Sometimes I get to be his chat person, so I get to listen in. And he'll go through very methodically, starting at the very beginning. What's a call? What's a put? What does it mean? And really get you comfortable with the different strategies. So if you haven't gone through that yet, that would help you a ton. Okay. Let's see. Debbie's saying, all right, they topped earnings. Mr. Producer, are you trying to tell me something? All right, my producer's not trying to tell me something, so we'll get back here. Let's look at Nike. This is going to be fun to take a look at here. Looks like from what Debbie said and from what Scott said, and Scott said initially it's a muted reaction, right? Needs some time. They haven't given their comments yet, right? They release the numbers, and then in a few minutes they'll do a conference call, which you're welcome to listen to. I wouldn't listen to it yet, okay, because we're in our class, but we'll take a look at it. Now, I put on a trade, okay, put on actually 2 trades on this one, on Nike. And I did a one that's a more conservative trade and one that's a more aggressive trade, okay? And I want you to know, because it's earnings, it's totally speculative. We don't know. Even if a trend is up, it doesn't mean the stock's going to go up. There could be bad news that comes out. There could be some bad numbers. They can be great numbers and say, oh, they were great numbers this quarter, but our next quarter is going to be a little disappointing, right? And that makes all the difference. We all got to find out together what the news is. Nobody really knows. So it was speculative in nature, but I wanted to go through it with you because this is what some of you are doing, right? And this is what some of you wanted. All right, let's go see what Nike's done. I put on a long call diagonal and a long call vertical. Because, I'll show you why because in a moment, but let's just kind of take a sneak peek. Okay, we're going to go to our 1 day, 1 minute chart. And I put in a little overall because this is where we got in today. Okay, so the black is today's price action. And then the gray over here on the far right is really what it's doing in after hours. Okay, so over here on the far right, I just zoomed in. This was yesterday's closing bell activity. It was down there about 65-ish. Kind of went sideways overnight. Not a lot happening, right? People are waiting for the news to come out. Today it ran up a little bit, pulled back a little bit. Oh, look at this. Let's see what it's doing. Yeah, it's kind of a little bit all over the place, isn't it? Looks like it closed at 65.63 when the market closed. Initial numbers are out. Looks like there's a low down there about 62, kind of flopping around now about 64 and some change. So maybe down a buck or so. Yeah, we'll have to kind of see what happens here. It's a little early to tell. Now, I want to get back to our topic of implied volatility and using implied volatility information to help make some decisions. Let's bring our chart back up here. We'll maybe peek on this a little bit later when we've been able to look through some things, give the market a chance to react. I'm not sure exactly when. Let's see when the conference call is going to be. Let me put my mouse on here. So that's out, and looks like the call is going to be at 4 p.m. Central Time, which is going on right now. So I guess they released the numbers and then started the conference call. Okay, so that might be going on right now. All right. Now, I did a couple of trades that both of them were kind of long trades, meaning buying strategies, a long call diagonal and a long call vertical. Why did I do that? Okay, let's give you a little bit of information here. Let's pull up a 1-year chart. And I have down here implied volatility so we can see when it goes up, when it goes down, right? When earnings come out, typically what happens, it's going to drop off. But where was it right now? Okay. Right now, today, or about the time I put them on, it was at a 0.47, 0.46, something in that range. And I wanted to see, well, how is that compared to the rest of the year? Okay. Looks like the high point in the last 12 months here was about 0.78. So quite a bit higher than where it is right now, right? If I put my mouse clear up here at the top. And it didn't go there a lot. You know, it had a 78, a 71. It's a little bit lower than that now. And then recent lows have been what? Recent low here is 24.24. Here, 0.25. Here, 0.32. 0.28, and then down here, the very lowest in the year, about 0.18. So sitting at 47, I would say maybe it's barely below the midpoint area, which would indicate, at least looking at it on the chart, that it's kind of mid-range, but maybe a little bit lower, meaning we're not looking at extreme volatility in it right now. Okay, what else can we look at? And if you want, feel free to tell me what you do look at. We're seeing this here on a chart. Let's come over here to the trade tab. And let me clear out that, get on our Nike. And let's look at a couple of things here. Over here on our far left-hand or right-hand side, the options that are due to expire tomorrow that have implied volatility baked into the numbers were extreme. Look at this. 172% implied volatility priced into the options that expire tomorrow. And then next week, just a week later, it's down here to 68%. So it has a little bit more than, I mean, it's more than double, almost almost triple. Maybe not triple, but close, right? 1.5 at least. Implied volatility priced in these options, meaning really, really pricey, because we know the news wasn't out. Now the news is out. What are we going to see tomorrow? We're going to see implied volatility come crushing out of all the options, but especially this front week that we see here. So there's that implied volatility to take a look at in terms of what's being priced into the options. Now, I've been sharing this market maker move with you. I use it every week in our straddles and strangles class. Some of you, I know you've been looking at it there. I'm going to share it with everybody here. Remember, anytime we share scripts with you, they're not guaranteed as to accuracy or time. Okay. And this, basically, this little script comes over here, it sees what the market maker move is, and it just graphs it for us and puts it on the chart. Okay, so if we come back here, and let me go to my studies, and I think I took it off. I forgot I took it off. Well, I better add it myself. Mine is called MMM for market maker move, and then I have set MMM on the chart. Okay, that's what it is. Let's say okay. Then we see I've got some labels that are showing, percentages as far as, year to date, what's it up, month to date, what it's up, as well as some fundamentals here. This is showing, it's kind of graphing that $4.63 move. That's the market maker move, which is about 7%. So it's an indication that, but the expectation is that it may move the needle on the price of the stock about 7%. And so it maps it out for us. Okay, so that puts it, was it 65? Not quite a $5 move, but it's up here about 70-ish. And then down here about, looks like 61 is for the pricing in those options as far as where the market maker thinks it was going to go, is between those two areas. And so we'd probably say, that's what's expected. We don't know that it'll actually do it, right? And we're really not going to know until tomorrow morning when the market opens, and we really see the reaction now that all market participants are there. There'll be some pre-market activity that you could come in and look at, like we saw the post-market activity, just kind of see where it is, because as the conference call goes on this afternoon, it could fluctuate quite a bit. Okay, now I want to come back here. Let's see here. Quick question from, I'm going to call you Jeff, even though it's J3FF. Currently 3:20 Central Time, 4:20 Eastern. So, you're letting me know it's not yet. Mine says here 4 o'clock. Oh, Central. Okay, you're absolutely right. Thank you. Thank you, guys. Let me know. Okay, actually, it hasn't been happening yet. Okay, I forgot. Sometimes this is in Central Time Zone when they post when the conference call is going to be. Okay, so they haven't chatted yet. All right. Let's go over here to the trade tab. So we talked about this implied volatility, what's priced into the options. And you can see as it gets a little further out, a couple of weeks out, and then gets into some of these monthlies, we've got implied volatility more like in the 40s. And even getting down to the low 30s, whereas these right here that are due to expire sooner have a lot in there. That means those options, a couple things, are really expensive. And especially for something like, say, December 19th, you're thinking, I want a piece of that. I want a piece of that volatility. Why not me? And you can experiment with different strategies to help you try to capture some of that implied volatility. We'll get into that in a minute. Want to spend a little bit of time here in today's option statistics. How many of you come down here and regularly look at the option statistics here? We're not going to go into all of them. There's a ton of stuff in this section, okay? But we are going to talk about the implied volatility numbers, what they mean. So the 52-week high for implied volatility is about 78 and the low is about 18. That's pretty similar to what we were seeing on the graph. When I went up to the high point, I went down to the low point. I believe those were pretty close to those numbers. Then we have the current IV percentile as 48, and it's pretty close, 0.47 here on the chart, 0.48, maybe there's a little rounding here and there. But that's letting us know, okay, it's kind of middle of the pack, right? 50 is absolutely middle of the pack because the scale goes from 0 to 100. So right now, it's kind of in the middle. I told you maybe just a little bit below the midpoint, which, 48 is just a little bit below 50. So it's kind of in the middle there. Now, we've got a couple of other things. We've got over the last 52 weeks, what has been the high? What has been the low? Well, the high's been 82-ish, and the low implied volatility, or historical volatility, I should say, is down at 15. So similar numbers, but taking into consideration more history. Okay. And then we get the current HV percentile, and it compares the levels to the previous year or to the past year. And where's implied volatility sitting right now compared to where it's been over the last 12 months? It's about 20%. So typically, if this number's a lower number, say 30 or lower, maybe you'd consider doing a buying strategy. If it's in the higher range, say it's in 70, 80, 90 or something like that, you might swing more to selling strategies. And it doesn't mean you have to do a total selling strategy by any means. It doesn't mean, oh, I should only do something that's selling some premium, but you might say, let's take advantage of that so that we can benefit from having some juicy premiums. At least right now, it's not that juicy though, right? Because the percentile's still fairly low. Where it is higher is just in these ones that are going to expire tomorrow. Okay. I asked you how many of you use this information. Michael says, yeah, I go here before but deciding on every trade. Michael, you get a big thumbs up from me. Fantastic. Like I said, I want you to be comfortable with implied volatility as a concept and what do these numbers mean. Now, do you have to go down here on every trade and look at it? If you're somebody that's newer to options, it might be a little overwhelming to you, quite honestly. Okay. Well, where's this number fit in? Where's this number fit in? It could feel like a little bit much. Michael, I imagine you've probably been trading for a little bit of time, and so it's information you can digest. But if it's not information that you are comfortable digesting, don't worry about it yet. If you're like, yeah, I'm good for these numbers on the side and I'm good for these numbers on the chart, right? If it's high, low, where it sits, and maybe even just using the 48%, the current IV percentile where it ranks, it's kind of middle of the road right now, that might be suitable for you for a long, long time, and that's fine. Somebody really wants to dig into some of this implied volatility a little bit deeper, that's where these statistics come into play. And then, of course, we've got some other columns that are fun to examine, but you might not want to spend that much time on every single trade doing that work. Scott says Nike's declining more substantially now. All right, interesting. Let me show you what we put on before class, and then we're going to do an additional trade here. So on Nike, we did 2 trades. Okay, premium here on Nike, we were able to sell a 64.62 short put vertical and bring in 72 cents. Now, if I pulled out the calculator and said max gain is 72 cents compared to a max loss of what? To minus 72 cents. Let me go back to where I wrote my numbers down here. That equates to, in the neighborhood, 72 divided by 128 is about a 56% return. What does the stock need to do? Well, the stock needs to, in this case, stay above our short strike price of 64. If it does, it's going to pay us very handsomely. Okay, and that can be one way to capitalize, try to capture that high implied juicy volatility. But because we don't know direction, we don't know what the stock's going to do, we don't know what they're going to say, it's totally speculative, both of these trades here. Let's see. So if we wanted it to stay above 64, let's go to our after hours and just see, take a peek where it is. And we'll go 1 day, 1 minute. And 64 is here. Currently, it's a little bit below that. Okay. So on that trade, then we would probably want to exit early if tomorrow it looks kind of like the same thing, so that don't take assignment on it if we don't want to. Okay. And hopefully we'd get in a situation where we're getting out before a max loss is reached, trying to minimize maybe what our exposure might be there. Okay. Second trade, let's come over to it. We did a diagonal. And we did a similar thing where we were trying to capture that juicy implied volatility on the options that expire tomorrow. Again, taking a bullish stance. We could have done one bullish and one bearish. Could have. I didn't in this case. You know, some of these retailers that maybe say here on a 3-month chart, let's say 6-month chart, some of these retailers that kind of struggled over the fall, some of them are getting a little love right now. Doesn't mean they will or that they're guaranteed to. Right? Nike, you just kind of, we don't know, right? With earnings, we just don't know. So as we come back here, what we did is we sold a 69 in this front week that expires tomorrow. Okay. And we bought a 68 that's a little bit out of the money, but not that far. Okay. It's a little bit, but not as much as what the market maker move might imply that it could go. We have an extra week on this one. So, you know, if the price on this 69 call expires lower, we might be able to keep a lot of this premium. And then we might have a little bit of time because the long leg doesn't expire till next week. Maybe we have a little bit of time for that leg to stabilize and maybe go up, just kind of depending on what the news is, how investors react to it. So this could kind of be a 2-part trade. I do want to show you real quickly the risk profiles here. Let's just go over to the Analyze tab. And here's our Nike. And let me just kind of delete the trade that's in here. And what I want to show you is what we have. So we're going to say hide simulations. And I've got some other trades in here from a different class. So the contracts we did in here, I think were 20 and 10. So I'm going to uncheck these from our straddle strangle class where we had a totally different trade going on here. Let's bring this back here a little bit. Let's make sure I only have my 10 and 20 contracts check marked here. So check mark on the 10, check mark on the 20, check mark on the 20. Okay. So looking a little bit. Let me go back to the monitor tab here real quickly. Yeah, it was 10, was 20. Which leg are we missing here? Maybe I need to scroll up. That's what I need to do. I need to scroll up. Here it is. All right, here's the one that I couldn't see because it was hidden, but it's marked. And so what we do is on this risk profile it's group doing both of them right now. And generally speaking, you probably wouldn't do true trades on the same stock. I wanted to do it here for our learning purposes. Okay. So what I'm going to do is I'm going to hide our short put vertical with 10 contracts. We're going to hide those, and we're only going to graph the 20 contracts of the diagonal. Now, our peak profitability you could see would be up here at the 69 strike price, which is our short leg. But there's kind of a swath here, right? There's a swath. And if I came over here and said set slices to the break even tomorrow, our break even line is down here. And right now it's showing at 58.37. This could change a little bit by tomorrow. On these diagonals, it's a little bit tricky to really nail down max loss, max gain right at the beginning of the trade. So it's going to be a little bit fluid. The purple line, remember, is our profit and loss right now. So it'll be as of, we'll change that date tomorrow. I'll change that to be the 19th here. But our turquoise colored line, that's as of options expiration. Now, here we did 10 contracts. So there might be a swath through here that somebody might be comfortable trying to target for profitability. In fact, somebody might say, you know, if I made $500 profit on it, I'm happy camper. I'm going to get out and possibly do that. Okay. somebody might also say, I'm going to keep those legs together. I'm just checking here real quickly, making sure. Yeah, okay, making sure which ones I've got on here. So we're looking at the 69.68 diagonal. And like I said, maybe it closes below our short leg. Maybe we keep that profit, and maybe the next week Nike runs up a little, right? We might not close it out altogether. Okay, let's look at our other trade. I'm gonna cut those off, and we're gonna go grab our 10 contracts here and our 10 contracts here. And you're gonna go, oh yeah, I'm kind of more used to that kind of a graph here. And let me just make sure it's unchecked here. All right, we're good. All right, so this is kind of what this is looking like right now. This one, we absolutely need the stock to do what? We need the stock on this short put vertical to basically stay above 64. Right now, it's not there. Okay, so we'll have to kind of see what it does tomorrow. We are not going to have time to necessarily do a change of polarity with this trade. Okay, because you need time for the option to be able to play out throughout some time to try to maybe make up for a deficit. But again, these were speculative in nature. No guarantee they're going to work. We'll have to see what happens tomorrow, and I'll update you. Next week, I'll update you on what we did. Let's see. RB Tech Trader says, how would one realize the max gain at the $69 point? Does one have to wait for expiration the day before? Wait for expiration or do it the day before expiration? So Saturday is the actual expiration. So tomorrow is the day to be able to kind of harvest that. Okay. And so it just kind of depends on what it does. All right. If it's not on the bullish side, both of those trades could be a little bit difficult. Okay. Certainly the short put vertical, we would be possibly assigned early if it's really deep in the money. And that's why if tomorrow the reaction is, yeah, it's not so positive, yeah, we may have to close out of that trade early to capture that peak that you're asking about here. This peak that we see, whether it's this trade or the other, is at options expiration, okay, which takes all of the whole day to get through. And not all the time gets implied volatility is going to drop across all the options on the chain, but it's not like it's going to be that same area come options afternoon, right, when they're getting closer to expiring. It kind of drops a lot, and then it just kind of maybe gradually decays a little bit. Okay, it's very hard, actually, even if it goes right at that peak, it's really hard to capture that. And that's why I'm talking about maybe a swath is maybe what we might be interested in saying, okay, if it's anywhere in this territory, would be happy campers. And even on this one, we might not say, oh, it's got to go clear up here to 5, whatever that is, 720 to get the max profit. Maybe we might be satisfied somewhere on this line of profitability, okay, but not total profitability, right? But at least some sort of gain here. So we'll be monitoring it tomorrow. On this one, we risked between the two trades. I wanted to keep our risk at $1,500, which is typically what we'll do in this account per trade. So I thought divide it up. Don't want to risk more than $750 in those trades just to keep our risk manageable. All right. That's a lot of implied volatility talk to throw at you, and volatility around earnings. You know, sometimes it ramps up, and like I said, tomorrow when the news is out, and even right now, you know, the implied volatility is going to be crushing out of those options. And so it's such a big component that you want to get fairly comfortable with it. And simply doing some paper money trades can help you do that. Okay. Now, I hope all of you are subscribers to our Trader Talks channel. That's where you'll be able to see previous classes, what we have on a playlist. If I jump over to mine here real quickly, if I can find the right screen. I'm not seeing the right screen immediately, but that's where you can find our content. If you're not comfortable with any of the strategies we talked about today or some of the concepts we've talked about, man, that's where you can find the playlist that Cameron put in the chat for getting started with options. Okay. Now, I did not see a survey out there today. All right. We've covered a lot of ground. We had a lot to cover. But if you found this helpful and enjoyable, go ahead, hit the like button on the way out. Okay. I'll update you next week. We've got a couple of things. We've got our new trade to update you on Nike. We've also got to finish our earnings trade up with Micron. That we still are in one of those trades, right? All right, you guys, last class of the day. Enjoy the evening, relax. We'll be back here right at the opening bell tomorrow morning with Trader Talks. It's going to be the ETF focus. And so it's not going to be recorded. You got to be there live to catch that information. So have a great evening, guys. We'll see you back here tomorrow right at the opening bell. Bye-bye.